Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menasce. This is the weekend edition where we interview notable people from the world of real estate investing. Today is no exception. We have a great guest all the way from Austin, Texas. Welcome to the show, Dipesh Sitaram.
Hey, good morning. How are you guys doing?
Very good. Well, great to have you here. And you, like my father, started out as a dentist, and so definitely understand the world that you came from. You're doing some interesting stuff, which I'm excited to talk about, but maybe before we do, perhaps give a little bit of your backstory and how you took that left turn in your career path.
Yeah, it's kind of a goofy story. I was a kind of more of a finance business guy through college who happened to get into dentistry, had a very boutique niche practice of 20 years in the Midwest. And all along, I'd been actively investing in real estate and, living off the passive income that the real estate investing provides, right? Over time, what happened was the real estate income outpaced the dentistry side of stuff. So I naturally kind of exited out that career and full-time into real estate and launching funds and things of that sort, which has been a lot of fun.
Awesome. So today you're completely out of dentistry, but oftentimes when you have that in your background, you don't want to necessarily leave all that knowledge by the side of the road. And it sounds like you haven't.
I haven't. Yeah. And it's really cool, because I had a very niche practice, especially in the world of treating people with TMJ. To this day, I still mentor, consult, and help the younger doctors come up in that particular specialty, right? So a significant portion of what I do is still mentoring and consulting, whether it's on the clinical skill set or helping them with wealth creation.
Fascinating. And so from a real estate standpoint, you owned your own building for your own practice and so on. And then you've been taking that now to a different level.
That's right. And over the years, I've invested in multiple asset classes, right? So call it hotels, multifamily, condos, healthcare. And when I look back retrospectively, so I retired about 4 years ago. When I look back retrospectively and looked at, what survived through the COVID time period, right? That's kind of my litmus test for things now. It was my healthcare real estate holdings that propped up everything else. So fundamentally, after post-retirement, I was more like, okay, I really want to become a subject matter expert, deep dive into that space. In order for me to do so, not only am I investing my own money, but also have other accredited investors come along for the ride as well. And that allows me to do bigger projects on an all equity basis, right? So without having bank debt or loans or anything like that, which has been a fun ride.
So you mentioned a litmus test being the pandemic and surviving through the pandemic, and that raises a number of questions because that was a transient event that benefited some and harmed others, and yet now in the rearview mirror, maybe some of those things have normalized. So folks that benefited, that benefit dissipated. How are you underwriting things today to see whether, because look, we are seeing failures in healthcare. Even now, we're seeing hospitals close down and things that you would think shouldn't happen because the demand side of the equation's there. And yet sometimes it's still happening. So how are you underwriting things? How do you decide? Because it's not just a physical asset. It's not just the building that generates the income. It's everything attached to it, right?
Correct. Yeah. So I keep a close eye on how the insurance payers work and all of that, right? About 15 to 20 years ago, there was a huge shift from doing procedures in a hospital OR setting into outpatient setting, right? Mm-hmm. Now we're seeing a shift from procedures being done that should be done in an outpatient care setting into a clinic setting. So my thesis is more of, I want to be involved in a surgery center type of stuff that has a component of clinic, component of outpatient surgery. That way the real estate is more stable in a sense that my tenants aren't going to leave or fold or anything like that.
It's one of these things, medicine is always a complex sale in the sense that, if you go to the corner store, you buy a chocolate bar, You are the decision maker, you're the consumer, and you're the one that's paying the bill. All three in one, right? And if a chocolate bar goes up today and it's $10, you say, I can do without. But in medicine, you have the consumer who's the patient. You have the decision maker that's the doctor. You've got the funder that's the insurance company with all kinds of constraints. And so it's a complex sale. And if you don't have your finger on the pulse of how that's working, you could totally miss the market.
That's right. Absolutely right. So one of the arms of the company that I'm involved with, that what we do is help consult the operating businesses within the four walls of the real estate too. And part of that is negotiating the payer reimbursement levels, negotiating vendor contracts and things like that, right? So not only does that help the doctor's office become more profitable, right? But it also helps secure our position in the investment as well. And it's a critical component of when we're underwriting a deal. I'm looking at all of that in terms of who are the tenants? Are the tenants willing to work with me from a holistic perspective as well? So how can I help them grow? By helping them grow, it kind of securitizes better their ability to pay the triple net lease, essentially.
Medical care and dentistry both are still going through tremendous amount of transition, a lot of consolidation. I mean, certainly the days of the sole practitioner with a receptionist and the sliding glass window, those days are over. It's right. These are all group practices, and the number of folks that are associates as opposed to real partners in this business, that ratio is changed dramatically. Most folks are employees at this point in one form or another, whether it's a medium-sized practice or big healthcare. How do you see that dynamic influencing what you do from a real estate standpoint?
Well, so one, we're looking at the stability of the larger organizations, because you guys can see it. There's a lot of these organizations that come and go, or just not well capitalized from a structural perspective. So the key in underwriting for us is looking at, hey, how stable is this larger DSO type organization or PE? What geographical areas are they concentrated in, right? Are they trying to bite off more than what they can chew? Or is it a space within healthcare that maybe they don't belong in? They're trying to get their footing into, right? But maybe they're a few years too early or ahead of their time or whatnot, right? So it's all the little nuances that are going to be critical to our underwriting.
When I look at a lot of the clinics that are emerging, we're seeing more and more add-on services, because look, there's only three ways you can grow your income. You can get more customers, you can raise your prices, or sell your existing customers more stuff. That's it. There's nothing else. So if your clinic now has, let's say, physiotherapy attached to it, or maybe a nutritionist or a dietitian and all these other add-on services, how many of those are an experiment? How many of them are profitable? How do you underwrite that aspect? Because these product line extensions aren't necessarily all created equal, right?
Right. Especially in the wellness space, right? So in the wellness space, you're seeing right now a lot of organizations kind of come and go, right? It's almost like they're testing it to see what's going to work, what's not going to work, right? A couple of years ago, it was stem cells. Now it's these different forms of peptide marketing that you see.
Yep.
And there's different methods of fat loss, and there's pills and units and ultrasounds, different things, right? So you kind of have to use judgment call and common sense on what you think is going to stick around and what's not, right? So for us, part of our thesis is the true surgery centers where you're doing orthopedics and things like that. Those are going to be kind of your steadfast, your bread and butter. It's not going away, right? Because if you've got to get a hip replaced, you got to get a hip replaced. There's no sense of peptide or stem cell or PRP that's going to fix it.
And telemedicine's not going to solve that one either, where some of maybe some of the triage and diagnostic that would have required a bricks and mortar location, some of that may shrink with telemedicine and some of the new technology, but the surgery centers will not.
Right. And the good thing with the surgery center, like robotic surgery has made tremendous advancement, right? But you still need a doctor to operate the robot. The way we see it is you're still going to need the doctor.
Yeah, 100%. So as you look at the strategy as you're underwriting opportunities in the marketplace, what are you seeing that is sticky, and what are you seeing that you say, this doesn't fit our investment mandate?
Yeah. So, for example, recently I've been seeing a lot of these wellness type centers, right? And that particular thesis kind of doesn't fit our box, mainly because it's a little early for it, right? We don't know which companies are going to outlast others and things like that. For us, the thesis is going to be our clinical surgery centers combined with the clinic setting facilities. So more specialty care because it's tried and tested. I don't see it going anywhere.
Absolutely. And if we're talking about things that are, let's say, insured services, we don't
Correct.
really have a healthcare system. We have a sick care system.
It's a sick care system, right?
And so if you talk about acuteness of demand, the wellness end of the spectrum, I'll put that in the vitamins category where they're maybe discretionary. Whereas if someone has an acute problem, they need it solved like right now, not in a week, not in a month, like now. And so the demand for those two products, even though it's all healthcare, they're very, very different. So therefore the value proposition associated with those are very different.
Right. Right. Especially like being on the real estate side of it, right? As opposed to the operating company side of it. When we're looking at stability of investment from the real estate side of it, we're going to lean more towards the surgery centers, the things patients are going to need, as opposed to what patients may want.
How do you see the continued flurry of consolidation, M&A activity impacting and potentially adding risk to even a real estate play that's, let's say, more hyper-local?
Yeah, so, the consolidation is going to continue. I don't see that going away. Residents, students are graduating with more and more debt.
Yep.
Therefore, coming out of the gate, where historically you'd come out of a residency, start your own private practice or whatnot, you're almost not lendable because you're already coming out with $700 to $1 million of debt, and it's a tough situation. So that consolidation with private equity is going to continue. I think we just have to be a lot more diligent in the underwriting in terms of underwriting more stable PE firms that'll be operating inside those four walls.
Absolutely. Well, Dipesh, if folks want to connect, if they want to learn more, what's the best way?
Yeah, visit the website at acurecapital.com. That's ACUERE capital.com.
Fabulous. Well, Dipesh, great to connect. And for the listeners at home, you definitely want to connect with Dipesh at acurecapital.com. Link will be in the show notes. And in the meantime, have an awesome rest of your weekend. Go make some great things happen. And we'll talk to you again tomorrow.